Welcome to this deep dive, into the global and Indian economies.
Okay.
We're going to be looking at a February 2025 macro chart book
Okay.
from JM Financial Asset Management Limited.
Right.
And trust me, it's packed with fascinating insights.
Okay.
Imagine this China's economy is hitting the brakes.
Wow.
Japan's central bank is actually raising interest rates.
Really?
And we have a new U.S. president who's making waves with their trade policies.
Oh, wow.
So buckle up as we explore how all of this is shaking things up, from global inflation trends to the U.S. Fed's moves and what it all means specifically for India.
You know what's striking is that while there's a lot of talk about a global slowdown, the picture is actually pretty mixed.
Okay.
If you look at the manufacturing data,
Yeah.
it's true that the Eurozone and Japan are contracting,
Right.
but the U.S. and China are still showing expansion.
Right. But it's not all about factories anymore, is it?
Yeah.
What about the services sector?
Exactly. That's a key point.
Okay.
Services PMI is actually above 50.
Uh-huh.
That's expansion territory.
Got it.
In all the major economies, it seems consumers are still out there spending, and the service industries are holding up well,
Yeah.
even if manufacturing is facing some headwinds.
Okay. So mixed signals on growth, but what about inflation?
Uh-huh.
It seems like it's creeping back up,
Yeah,
but not everywhere, right?
that's right. The U.S., Eurozone, and Japan are all seeing some upward pressure on prices, mainly because of things like housing and transportation costs.
Yeah.
But China,
Hmm.
their inflation is staying low, mostly because domestic demand is pretty weak.
But here's where things get really interesting. The chart book flags the new U.S. president's trade policies as a major wild card.
Wow.
Those tariffs on China, Mexico, and Canada could really shake things up.
Absolutely. Those tariffs have the potential to disrupt global supply chains in a big way, which could lead to even more price increases down the line. It's a situation we need to keep a close eye on because those ripple effects can be felt worldwide.
Speaking of things with global impact, the chart book highlights this fascinating point about money supply. It's up in all four major economies:
Wow.
the U.S., Eurozone, Japan, and China.
Wow.
That's pretty surprising given how different their interest rate environments are.
You've got the U.S. Fed trying to shrink its balance sheet, but at a slower pace than before.
Mm-hmm.
Then you have the Eurozone, Japan, and China all seeing their money supply increase, even though their economies are in very different states.
So how is that even possible?
Yeah.
How can all these economies have expanding money supply but such different growth and inflation stories?
That's a great question. The answer lies in a complex mix of factors. We're talking government spending, consumer behavior trade dynamics, even global investor sentiment plays a role. It's almost like each country is trying to walk a tightrope, balancing the need to control inflation with the desire to keep their economies growing.
Yeah.
And frankly, no one has the perfect playbook for this situation.
It's a giant economic puzzle with pieces that are constantly moving.
Yeah.
Now, before we zoom in on India, let's take a closer look at the U.S. labor market.
Okay.
The chart book suggests it's surprisingly strong despite some recent softening.
The U.S. unemployment rate is holding steady at a very low 4%, which is pretty remarkable considering all the global headwinds we've been discussing. It suggests that even with global uncertainty and some sectors struggling, the U.S. job market is remaining resilient.
Right, and even though we saw a dip in non-farm payrolls in January 2025, jobless claims have actually dropped recently.
Okay.
So is this a sign of strength?
Yeah.
Or is the U.S. labor market about to hit a wall?
That's the million-dollar question.
Yeah.
These mixed signals make it tough to predict what's next. We'll need more data to paint a clearer picture. But it does raise an interesting point. What happens if the U.S. labor market does weaken? How will that impact the global economy, especially emerging markets like India? We'll need to keep that in mind as we dive deeper.
Okay, so we've set the global stage. Now let's shift our focus to India. The chart book really digs into the recent union budget for fiscal year 26, and, it feels like India's trying to walk a tightrope of its own.
Right. On one hand, the government's trying to rein in the fiscal deficit, essentially the gap between spending and revenue. They're aiming to reduce that gap, which is generally seen as a positive for long-term economic stability.
But at the same time, they're also trying to boost demand by cutting taxes.
Yeah.
And of course, they're continuing to invest in infrastructure, but that growth in spending has peaked. So it's this classic dilemma, right?
Yeah.
Fiscal prudence versus stimulating growth.
Exactly. It's like trying to balance on a seesaw, too much weight on one side and the whole thing tips over. The key question is how effectively can India manage both objectives,
Hmm.
especially with all this global uncertainty swirling around?
And how is corporate India handling all of this? It seems like profitability is bouncing back in most sectors, but some are lagging behind. This is where things start to get really interesting for anyone thinking about investing in India, wouldn't you say?
Absolutely. Overall, Q3 of fiscal year 25 saw a healthy 17.8% year-on-year profit growth, but that doesn't tell the whole story. Some sectors like crude oil and automobiles really struggled. So if you're thinking about putting your money in India, you can't just look at the overall numbers. You need to understand which sectors are thriving and which ones are facing headwinds.
So let's talk about those headwinds. What are the demand indicators telling us? The chart book points to some mixed signals emerging, with certain sectors starting to soften.
We're seeing some cooling in areas like commercial vehicle sales, energy requirements, and even two-wheeler sales. This all points to a potential slowdown in urban demand.
But wait, there's a potential silver lining here, right? The chart book mentions that Rabin is sowing the planting of winter crops is looking strong. This could be a big boost to the rural economy.
And that contrast between urban and rural India is crucial. What if rural demand picks up while urban demand cools down? That could have a massive impact on the overall economic picture.
It's like two different engines powering the economy, and they're running at different speeds. Speaking of contrasting forces, let's look at trade. India's trade deficit is widening, and the chart book breaks down the reasons why.
It boils down to this space. India's imports, particularly gold and silver, are surging, while merchandise exports are growing at a much slower pace.
So we've got this widening trade deficit, but there is some good news buried in the chart book. It looks like services exports are actually doing quite well, which helps to balance things out a bit. But how does all of this impact you, the listener? Are there benefits or risks you need to be thinking about given your own line of work or investments? It's definitely worth pondering. Now let's talk about the rupee. It's facing some pressure against a strong US dollar, which isn't all that surprising considering the global currency market roller coaster we've been discussing.
Right. You've got the U.S. cutting interest rates while simultaneously trying to shrink their balance sheet.
Mm.
You've got the new U.S. president's trade policies adding fuel to the fire. And on top of all that, Japan is actually raising interest rates. It's no wonder the currency markets are volatile.
It's enough to make your head spin, but the chart book does point out that India has a bit of a safety net, high foreign exchange reserves.
Those reserves give the Reserve Bank of India, the RBI, some breathing room. They can step in and smooth out some of the rupee's fluctuations, which helps to provide stability. It's like having a financial shock absorber for the economy.
Okay, good to know there's a shock absorber in place. Now let's switch gears and talk about inflation in India. The chart book shows that it's cooled down to a 5-month low, which sounds like good news.
It is. CPI inflation came in at 4.31% in January 2025, and that's largely thanks to cooling food prices, which, as we discussed, is tied to those promising rupee sowing figures. This all suggests that food inflation might stay under control for a while.
And the RBI seems pretty comfortable with this inflation trajectory. They've adopted what's called a dovish stance, which basically means they're less worried about inflation and more focused on supporting growth. But what does this mean for you?
Well, lower inflation is generally good news for your wallet. It means your money goes further. But there's a flip side to this. It can also impact things like interest rates and investment returns. So it's a balancing act, as always.
Right, there are always trade-offs. Speaking of things that impact interest rates, let's dive into a slightly technical topic, liquidity in the Indian financial system. The chart book mentions that things have tightened up recently.
Liquidity just refers to how easily money is flowing through the system. When liquidity is tight, it means there's less money readily available for lending and investment. In India, this tightening is happening partly because of tax outflows, basically people and companies paying their taxes, and partly because of the RBI's potential intervention in the foreign exchange market, which we talked about earlier.
So why should the average person care about this?
Well, when liquidity tightens, it can impact everything from interest rates on loans to borrowing costs for businesses, and those things ultimately affect economic growth, which impacts everyone.
So it's all connected even if it seems technical at first glance. But the chart book does mention that the RBI is trying to ease the situation.
Exactly. They're taking measures like conducting open market operations, that's when they buy bonds, to inject money into the system, and holding variable rate repo auctions, which is another way to increase liquidity.
So it's like the RBI is constantly adjusting the knobs and levers to keep the financial system running smoothly. Now let's bring this all together and look at the RBI's overall policy approach. That recent rate cut, which brought the policy repo rate down to 6.25%, Seems like a clear sign they're prioritizing growth.
Absolutely. And the new RDI governor has said publicly that he's confident about where inflation is headed and is open to further easing.
That's a pretty big contrast to the US Fed, which is still tightening monetary policy. It really highlights the different economic realities and priorities in these two countries.
The U.S. seems to be laser-focused on controlling inflation, even if it means risking a slowdown in growth. India, on the other hand, seems more comfortable with a bit of inflation if it means they can keep the economy expanding. And, the chart book offers some interesting insights into how India's bond market is reacting to all of this.
Oh, you mean how the yields on Indian bonds have softened following that rate cut? It makes sense when the RBI cuts rates, bond yields typically go down.
Exactly. And it's worth noting that changes in bond yields have a ripple effect on all sorts of things. Think mortgage rates, borrowing costs for businesses, even your returns on certain investments can be affected. It's all interconnected.
It's like a chain reaction with the RBI's decisions setting things in motion. Speaking of chain reactions, let's shift gears and talk about foreign investment flows into India. The chart book shows that foreign portfolio investors, or FPIs, have been pulling money out of Indian equity markets lately.
That's right. We're seeing FPIs selling off Indian stocks. And there are a few reasons for this. First, there's all that global market volatility we talked about earlier. When things get shaky, investors tend to get a bit nervous and pull back.
Plus, there's the uncertainty surrounding the new U.S. president and their policies. And then you got some concerns about corporate earnings growth in India, which is understandable considering some of the headwinds we've discussed.
Right. It's a reminder that even though India has a lot going for it economically, it's not immune to global trends and investor sentiment.
But here's an interesting twist. While FPIs have been selling stocks, they've actually been buying Indian debt.
It's a bit of a head-scratcher, isn't it? It seems like they're more cautious about Indian equities right now, but they still see value in Indian bonds, perhaps, because they offer decent yields in a world where interest rates are generally low.
So maybe they're saying, we're not so sure about the short-term prospects for Indian companies, but we're still betting on the long-term stability of the Indian economy.
That's one way to look at it. Now, shifting gears once again, let's talk about initial public offerings, or IPOs in India. The chart book shows a lot of activity on that front lately.
It seems like the IPO market in India is really heating up. Companies raised a huge amount of money through IPOs in fiscal year 25, way more than the previous year.
It's a sign that investors are hungry for opportunities in India, and it also reflects the growing maturity of the Indian capital markets. Companies see going public as a viable way to fuel their growth, and investors are eager to get in on the ground floor.
And it's not just IPOs. The chart book also mentions that corporate debt issuances are up as well.
Right. Companies are raising capital through both equity and debt markets, which is a good sign. It suggests that businesses are feeling confident about the future and are willing to invest and grow.
So there's a lot of capital flowing into the Indian economy, which is encouraging. But let's circle back to those domestic demand indicators we touched on earlier. The chart book digs a bit deeper and offers some additional insights into what's happening on the ground. It's like taking the pulse of the Indian economy, wouldn't you say?
Absolutely. Those indicators give us a real-time view of how different parts of the economy are performing. And the chart book tracks a whole range of them, everything from commercial vehicle sales and energy requirements to passenger traffic and even tractor sales. What's the overall message you're seeing?
Well, it seems like there are definitely some pockets of strength, but a number of sectors are also showing signs of slowing down. For example, we talked about how commercial vehicle sales, which are often a leading indicator of economic activity, have started to cool off.
And the chart book shows that energy requirements, another key indicator, have also softened. This all suggests that the pace of economic growth in India might be easing a bit.
But before we jump to any conclusions, we should remember that the chart book also highlighted strong rabi sowing, which is a positive sign for the rural economy.
Yes, that's crucial. How the rural economy performs has a big impact on overall growth in India.
And there's another interesting detail from the chart book. Demand for work under the Mahatma Gandhi National Rural Employment Guarantee Act, or MGNREGA, seems to have bottomed out. This is a government program that guarantees employment in rural areas. So if more people are seeking work under this program, it could indicate that rural incomes are stabilizing or even improving.
Right, it's like a counterbalance to the softening urban demand indicators we've been discussing.
Exactly. Two different parts of the economy telling different stories. Now, the chart book also dives into the government's spending patterns, especially when it comes to capital expenditure, or CapEx.
CapEx is essentially government spending on things like roads, bridges, and other infrastructure projects. It's crucial for long-term economic growth, And the chart book shows that the government is still investing in this area, but the pace of growth has slowed down a bit,
So they're still spending, but maybe not as aggressively as in previous years.
which makes sense considering their efforts to consolidate finances and reduce the fiscal deficit.
It's that balancing act, again, trying to manage both short-term needs and long-term sustainability. Now let's zoom in on some specific sectors that the chart book analyzes. It provides some really interesting data on key industries like banking, automobiles, and the 8 core industries, which include things like coal, crude oil, natural gas refinery products, fertilizers, steel, cement, and electricity.
Those are some heavy hitters in the Indian economy.
Uh-huh.
So what's the story there? What insights does the chart book offer?
Well, let's start with banking. The chart book points out that bank credit growth has been outpacing deposit growth. Basically, banks are lending money faster than people, and businesses are depositing it.
That's an important point because it can impact banks' ability to keep lending and support economic activity.
Exactly. If this trend continues for too long, it could put a strain on banks' liquidity and potentially limit their lending capacity.
So that's something the RBI will need to monitor closely as it tries to balance growth and financial stability.
Yeah.
Now, what about the automobile sector?
Well, the chart book shows that while overall corporate profitability in India is improving, the automobile sector is lagging behind.
It's not too surprising considering all the global trends we've discussed. Rising interest rates in many parts of the world, those supply chain disruptions and the inflationary pressures we talked about, they've all hit the auto industry pretty hard.
And in India specifically, you've also got factors like rising fuel prices and increased competition, especially from electric vehicle manufacturers. It's tough out there for traditional automakers. It just goes to show that even when the overall economic picture is positive, there will always be sectors facing unique challenges. Now, what about those 8 core industries?
Ah, yes, the backbone of the Indian economy. Their performance is always worth a close look. What's the chart book telling us?
Well, the data shows their growth has been a bit uneven. Some sectors like coal and steel have done relatively well, while others like crude oil and natural gas have struggled.
And it's worth noting that the overall growth rate for these 8 core industries, while still positive, is lower than what we've seen in previous years.
Yeah.
It's another piece of evidence suggesting that the pace of economic expansion in India might be moderating.
So there's a lot to unpack here. We've got this complex interplay of global and domestic forces, and it's all having a real impact on people's lives. But before we wrap things up, I think it's crucial to step back and think about what all of this data means for the average person in India. How are these trends playing out in their daily lives? It's easy to get lost in the numbers,
Yeah.
but ultimately economics is about people.
Right.
So how are these trends playing out in the lives of everyday Indians?
That's a question worth considering. The chart book focuses on the big picture, but we can make some educated guesses. For starters, that easing inflation we talked about,
Yeah.
that's a win for consumers.
Yeah.
It means their money goes further and they don't feel the pinch of rising prices as much.
And with the RBI in a dovish mood and cutting interest rates,
Yeah.
borrowing costs could come down for individuals, which could boost spending and give the economy an extra jolt.
Exactly. But it's not all rosy. That slowdown in certain sectors could translate into fewer job opportunities and less wage growth, which would definitely impact people's livelihoods.
And we can't forget about that widening trade deficit and the weaker rupee. Those could lead to higher prices for imported goods, putting more pressure on household budgets.
Right, so it's a mixed bag for the average person. There are positives and negatives, and the overall impact really depends on individual circumstances. But this is exactly why understanding these economic trends is so important. It helps you make informed decisions about your own finances and plan for the future.
So we've covered a lot of ground here. We've looked at the global economic forces at play, dug into the intricacies of the Indian economy, and even considered how it all trickles down to impact individuals. What are some key takeaways you think our listeners should walk away with today?
First and foremost, I think the big takeaway is that the global economy is in a state of flux. We're in uncharted territory with lots of uncertainty and volatility. Things can change quickly, and it's more important than ever to stay informed and be adaptable.
I completely agree. But here's the thing, even with all this uncertainty, there are opportunities out there. India, with its strong growth potential and dynamic entrepreneurial spirit, continues to be a bright spot on the global stage.
Absolutely. But it's not without its challenges. India still needs to tackle inflation, boost domestic demand, and attract more foreign investment.
So it's a story with both bright spots and potential pitfalls.
And that's why it's so crucial to look beyond the headlines, to really dig into the nuances of these economic trends. That's what we've tried to do today in this deep dive, and I hope our listener has found it valuable.
Now, before we sign off, I want to leave our listener with a final thought to ponder. We've talked a lot about the global economic landscape and where things might be headed. But the big question is, where does India fit into all of this?
Can India maintain its growth trajectory and leverage these global shifts to its advantage? Or will it get caught in the crossfire of trade tensions and geopolitical uncertainty? These are the questions we need to be asking ourselves as we navigate these turbulent times.
It's certainly a fascinating time to be watching the world unfold. And as always, we encourage you, our listener, to stay curious, keep exploring, and keep those critical thinking skills sharp. Because in a world as complex as ours, knowledge truly is power.
Well said. And who knows, maybe your insights will be featured in our next deep dive. Until then, keep those questions coming and stay engaged.